In our All-Star Fed panel, we have Kristen Bitterly, Citi Global Wealth Head of North American Investments. Welcome, Kristen. And David Kelly, JPMorgan Asset Management Chief Global Strategist. And Jim Caron, he's Morgan Stanley's Investment Management Co-CIO of Global Balanced Funds. Jim, I'm going to begin with you. You put a stake in the ground and say the Fed will raise rates, but that'll be it. Why do you believe that?
Well, look, I mean, I think we all know what the issues are right now in the economy. Obviously, some of the small banks, and we are starting to see some slowing. So I think it's time for a pause. The question, though, for me, is that the markets right now are priced as if the Fed is making a mistake, that there's going to be cuts immediately after that. But the way that I see it, the Fed is also going to have a hawkish pause. There's going to be no mea culpa. So the key is to listen to the press conference, see how the Fed actually explains this, because the markets are not necessarily agreeing with a hawkish pause, and I think that's what we end up getting.
David Kelly, your reaction to that, and I still remember what you said when we began this cycle, and the history tells you that the Fed usually goes too fast, too far, for too long. Is that what's happening here, and what do you think will happen today?
Yes, and to Jim's point, I think they're going to stay too tight for too long before they have to cut rates aggressively in 2024. Yeah, I agree that they're going to go 25 basis points today. I think they will change their forward guidance. You know, the forward guidance in the statement last month or in March suggested that they were likely to make see a further increase. I think they'll say that, you know, they'll assess the data to see whether they should make any further adjustments to interest rates. But I think they'll make it clear that they could be done. The problem is, I think they'll also try to make clear, particularly in the press conference, that they've no intention of cutting rates between now and the end of the year. Now, that's their plan. I think they'll change their plan when they see a negative payroll read later on this year, which I think is quite possible. But I think they'll stick to it for too long, and therefore they'll have to cut more aggressively next year.
Kristen, how about you? Where do you come down on this debate?
We see a 25 basis point hike today, and we're very hopeful that that's the last. We believe that they should pause. I think that Chair Powell's going to keep his options open, and we're going to hear a lot of the same as to what we heard before about being data dependent. Our biggest challenge in this, and why we've been very defensively positioned within our portfolios, is the fact that when you look at the leading indicators have declined by 8 percentage points, which in any other cycle would have been a signal to the Fed to pause. And so this is something that leading versus lagging indicators, what are their benchmarks, what are their North Stars? And so I do think one thing that he will reference, though, is tightening credit conditions. We expect some commentary about regional banks and what the impact of those tighter credit conditions is going to have going forward.
Jim, back to you. David mentioned the labor market. We got news earlier this week that job openings declined sharply. Is that kind of, to use the cliche, a canary in the coal mine, that some of the effects of higher rates are really beginning to dig into the economy?
Undoubtedly. I mean, look, we're supposed to have a slowdown when the Fed hikes rates, and that's what we're seeing. The thing that's been keeping the market somewhat afloat is that the labor market's been strong, consumption's been good, so therefore profit margins and company earnings have been holding up okay. But it's really only a matter of time before that really slowly starts to deteriorate, and the question is how much and how deep and for how long, and then that's going to really gauge what type of a slowdown or even possibly recession that we may end up having. So I think that's really the key point here, and I think Powell's got to really balance the tight labor market conditions, the sticky inflation, but also the need to say that there's enough hikes in the pipeline already at the moment that it'll probably do the job for it. It doesn't need to do any more than this.
And we should remind everybody that we won't get the projections or the dots as they're called today, so a little bit less information than we've had in some other meetings. And that said, it's always, you know, the statement, the language in the statement, and then the press conference with Chair Powell. David, I guess there's some questions about whether they'll, you know, use the word yet in their statement to kind of indicate some flexibility about rate hikes or not here. And we'll come back to you in just a moment.